The tax bracket that let you move money into a Roth at 12% closed forever on January 1st, 2026. But that is not actually the part that should scare you. The part that should scare you is buried in a 400-page IRS guidance document from 2023, a rule about inherited IRAs that is going to force millions of Americans to pay taxes on money they never asked for at the worst possible moment in their financial lives, at rates that are now permanently higher than they were 30 days ago. I read the document. This is what it means for you. Here's what actually happened to the American tax code in the last 30 days, and why the conventional Roth conversion advice you have been getting is already outdated. The Tax Cuts and Jobs Act of 2017 created something genuinely rare in the history of American tax law. A scheduled, pre-announced expiration date on lower tax rates. They wrote the sunset right into the legislation. December 31st, 2025. The sale had an end date printed on the receipt. You had 8 years to buy at the discount. And now, in early 2026, the sale is over. The brackets reverted, and the standard deduction, which had been $30,000 for married filers, just shrank to approximately $16,600, which alone pushes an extra $13,000 of income into a taxable bracket for the average household. That is what changed in 30 days. And most people are treating it like a weather event, something that happened to them, something outside their control. And here is the thing, the people who will be fine knew this was coming in 2017. They had 8 years to prepare. The people who are not fine were waiting for political certainty. And political certainty in American tax law is a thing that has never existed in the history of the Republic. The tax code has been amended more than 5,000 times since 1986. 5,000 times. You were never going to get certainty. Certainty was the trap. Let me explain exactly what changed, what it means. And this is the part that nobody is connecting right now. Why the new environment actually created a window that is almost as good as the old one, if you know where to look. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They don't account for bracket inflation, RMD projections, or the inherited IRA rules I am about to explain. It uses BlackRock and Vanguard modeling logic to expose the weak points in your specific plan. And I only ask for your email to send the report so I don't store any of your financial data. Link is in the description. In a few minutes, I'm going to show you a calculation that explains why someone with $800,000 in a traditional IRA is now functionally 2 full years behind someone with the same balance sitting inside a Roth. But first, let me show you how broken the standard advice has been and how a well-meaning financial professional cost one entirely fictional, entirely realistic man roughly $400,000 in unnecessary future taxes just by saying wait and see 3 years in a row. Think of the American tax code as a department store. In 2017, Congress put every tax bracket on clearance and posted a sign on the door. Sale ends December 31st, 2025. 8 years. 8 years of discounted Roth conversion rates. The 12% bracket, the 22% bracket. The standard deduction nearly doubled. And Fidelity's data shows that Roth conversion activity hit record levels in 2024, which sounds great until you look at the average conversion size. The average household doing a Roth conversion in 2024 converted approximately $47,000. The households that are actually going to retire wealthy converted closer to $150,000 per year for the last 3 years of the sale. The clearance rack was right there. Most people just bought one shirt. That metaphor is going to keep coming back because the clearance rack is how I want you to think about every low-income year between now and your first required minimum distribution. The clearance rack does not disappear when the sale ends. It moves to a different aisle. And right now, most people don't know where the aisle is. There's a guy, I am going to call him Dave, 58 years old, retired in 2023 after 30 years in pharmaceutical sales. Good earner, disciplined saver. He accumulated $900,000 in his 401k and rolled it into a traditional IRA the week he stopped working. His financial advisor, a competent, well-dressed man who charged 1% of assets annually and drove a very nice car, looked at Dave's situation in 2023 and said, Dave, you are in the 22% bracket right now, but your first required minimum distribution is not until 73. Let's wait and see where the political winds blow before we start any conversions. Dave waited. In 2024, same advice. In 2025, same advice. January 1st, 2026, Dave's 22% bracket became a 25% bracket. His $30,000 standard deduction became approximately $16,600. That standard deduction shrinkage alone pushed an extra $13,400 of Dave's income into a taxable range he was not in before. And Dave is now sitting on $900,000 inside a traditional IRA, watching it compound toward a number that is going to generate an RMD bomb in 15 years at rates that are permanently higher than the ones he slept through for 36 months. The advisor still charges 1%. The advice was free. Now, you might be thinking, Tom, 25 versus 22, that is 3 percentage points. That is a rounding error. And this is exactly where comfortable math ends and uncomfortable math starts. A 60-year-old with $900,000 in a traditional IRA growing at 7% annually will have approximately $4.6 million by age 85. For those born in 1960 or later, which covers anyone currently 55 or younger, the Secure Act 2.0 pushed the required minimum distribution age to 75, not 73. So the bomb has a slightly longer fuse. The explosion is slightly larger. At age 75, the RMD on that $4+ million balance, using the IRS Uniform Lifetime Table distribution period of 24.6 years, is approximately $170,000. On top of Social Security, which for a dual income household, retiring comfortably might be $80,000 combined, you are looking at $250,000 in mandatory taxable income, with no ability to control the timing, no ability to reduce the amount, and a marginal rate that is heading toward 28 or 33% under the reinstated pre-TCJA rate structure. Compare that to someone who converted aggressively during the sale window. Say they paid 22% on 3 years of $150,000 conversions, $450,000 converted, roughly $99,000 in taxes paid. That money is now growing, tax-free, compounding every year, exempt from RMDs permanently, and will pass to heirs without a tax event. $99,000 to exempt $4 million from taxes. That is not a tax strategy. That is a business deal. So why did most people not do it? The reason is psychological. Paying a tax today, writing the check, seeing the number, feeling the actual dollar leave your account is more emotionally real than avoiding a larger theoretical tax in a future that does not feel urgent yet. Behavioral economists call this present bias. I call it the reason most financial mistakes are brain problems wearing math costumes. Dave did not fail because he calculated wrong. Dave failed because his brain told him that paying taxes now feels worse than paying taxes later, even when a 5-minute spreadsheet shows the opposite clearly. And his advisor, who is compensated as a percentage of the assets he manages, had no particular financial incentive to encourage conversions that reduce the balance of the account he gets paid on. I am not saying the advisor is corrupt. I am saying the incentives are misaligned. Understanding that misalignment is worth more than any single investment strategy I can give you. This is where it gets really interesting. And I mean that literally, because this next part is the thing that is generating almost no coverage right now, despite being the single biggest structural change to the Roth landscape since the strategy was invented. Under the Secure Act 2.0, passed in December 2022 and effective for plan years after December 31st, 2023, Roth 401ks no longer have required minimum distributions. Let me say that one more time, slowly, because it is important. Before 2024, if you had a Roth 401k at work, you still had to take RMDs at the applicable age. Your money was in a Roth tax-free growth, tax-free distributions, but you still had to start withdrawing on schedule. Starting 2024, your Roth 401k can sit there compounding forever, or at least until your heirs inherit it and the 10-year rule kicks in. But that is a different conversation. By the way, hit subscribe if you like the content, otherwise YouTube's algorithm may never show you my videos again. Here's why the no RMD rule on Roth 401ks matters enormously right now. The contribution limit for a 401k in 2025 was $23,500, or $31,000 if you were 50 or older. There's also a super catch-up provision under Secure 2.0 for people between 60 and 63. Their limit jumps to $34,750. And critically, there is no income limit for contributing to a Roth 401k. Zero. A person earning $2 million a year can max out a Roth 401k if their employer offers it. Compare that to the Roth IRA, where the phase out for single filers in 2026 starts at approximately $160,000 and cuts off around $175,000. High earners have been locked out of direct Roth IRA contributions for years. The Roth 401k, with its no RMD rule, is the legal workaround that most HR benefit presentations never mention. And then there is the mega backdoor Roth, which deserves its own dedicated video, but the short version is this. If your 401k plan allows after-tax contributions and either in-service withdrawals or in-plan Roth conversions, you can potentially contribute up to approximately $70,000 total to your 401k in 2026 employee and employer combined and convert the after-tax portion directly to Roth. On a $23,000 employee Roth deferral with a $10,000 employer match, that is potentially $37,000 in additional after-tax space that converts to Roth with minimal tax impact because you already paid taxes on those after-tax dollars before they went in. Most plans do not advertise this. Call your HR department. Ask specifically whether the plan allows after-tax contributions and in-plan Roth conversions. If they look at you like you have two heads, that is actually a useful signal. It means you have done more research than the person administering the plan. Ask anyway. Escalate to the plan administrator. The answer is in the plan document. Now, here is what nobody is telling you about the political landscape, and this is the part that changes the entire strategic calculation. You think the problem with Roth conversions in 2026 is that the TCJA expired and rates went up, making conversions more expensive. That is exactly the wrong frame. The TCJA expiration is not the problem. It is the context. The actual problem, the thing that is costing people money right now, is that a large portion of the population is treating the end of the sale as the end of the opportunity. They are not converting because they believe the discounted window is closed. And because they believe that, they are letting their traditional IRA balances grow unchecked, which means larger RMDs, higher marginal rates in retirement, and a larger inheritance tax bomb for whoever inherits the account. The clearance rack closed January 1st. The store is still open. If you are currently in a low-income year, retired but not yet collecting Social Security, or in a sabbatical, or in a business transition year, you may still have significant headroom in the 25% bracket. The 25% bracket for married filers in 2026 runs up to approximately $182,000. If your income right now is $60,000, you have $122,000 of runway before you even hit 28%. Converting $100,000 this year at an effective blended rate of maybe 22%, because the lower brackets fill first, is still dramatically cheaper than the 33% you may face on RMDs during your peak retirement years. The percentage changed. The logic did not. A conversion at 25% still beats a forced distribution at 33% by a margin that compounds for decades. Here is the number that should make you genuinely uncomfortable, regardless of where you are politically. The federal deficit as of early 2026 is approximately $36 to $37 trillion. Annual interest payments on the national debt crossed $1 trillion for the first time in American history during 2024. The Congressional Budget Office has run multiple scenarios in which future tax rates are structurally higher than current rates, not because of ideology, but because of basic arithmetic. When a credit card balance is that large, the minimum payment keeps rising. It is not a conspiracy. It is a spreadsheet. A Roth IRA sitting inside that environment is a legally protected vehicle that converts a future political unknown, what will tax rates be in 20 years, into a known fixed cost that you pay today at a known rate. You are in effect buying your tax liability at today's price rather than tomorrow's price. And in an environment where the structural pressure on rates is upward, that is a very good deal. Comedic pause. I am sure someone in the comments is going to say that the government might tax Roth IRAs someday. They might. They would need to pass legislation, survive a constitutional challenge, and explain to every voter why their retirement account just got taxed twice. I am not dismissing it entirely, but if we are pricing in the scenario where Congress retroactively taxes Roth IRAs, I would argue that the broader investment environment at that point is going to have much larger problems than anyone's IRA structure. Prepare accordingly. Now I want to introduce something I have been building toward, and it is the subplot that ties the whole thing together, not just for you, but for the people who inherit whatever you leave behind. The Secure Act of 2019, not 2022, the original one eliminated what was called the Stretch IRA. Before 2019, a non-spouse beneficiary who inherited an IRA could take distributions over their own life expectancy. A 35-year-old inheriting a $2 million IRA from a parent could stretch those distributions over 40 or 50 years, keeping the balance invested and compounding, taking small distributions that barely touch the top of their bracket. That strategy is gone. Under current law, most non-spouse beneficiaries must empty the inherited IRA within 10 years of the original owner's death. And then, in 2023, the IRS issued final guidance clarifying that if the original account owner had already begun taking RMDs, the beneficiary must take annual distributions during the 10-year period, not just one lump sum at the end. Here is why this matters to you, specifically. Even if you are not planning to die anytime soon, if you leave a traditional IRA to your children, they will be forced to withdraw that money, potentially hundreds of thousands of dollars per year, during what are very likely their highest earning years. A 45-year-old earning $140,000 annually who inherits a traditional IRA and is forced to take $80,000 per year in distributions is now earning $220,000 in taxable income. That pushes them from the 25% bracket into the 28% bracket, potentially approaching 33% on distributions they did not choose at a time they did not choose, from a tax bill they did not see coming. The same money inside a Roth IRA, still zero taxes on distributions. The inherited Roth still has the 10-year rule. Your kids still have to empty it within 10 years of your death, but they can let it compound tax-free for all 10 years and take one distribution at the end, completely tax-free, while the balance has been growing uninterrupted. This is the inheritance angle that most financial plans never model. The reason is structural. Your advisor's client is you. Their legal obligation is to you. Your children's tax situation in 30 years is not their problem, which means if you do not force this analysis yourself, nobody is going to do it for you. The clearance rack was right there. And the person who buys at the clearance rack today is not buying for themselves. They're buying for the next generation. Let me make this concrete with a case study, because I want this to feel like your situation and not a textbook example. Marcus and Linda, both 52 in 2026, born in 1974. Marcus is in corporate finance. Linda runs a boutique consulting practice. Combined income is $240,000. They have accumulated $600,000 total in traditional IRAs. Marcus rolled over a 401k from his last employer. Linda built hers through SEP IRA contributions over 12 years as a self-employed person. Under the pre-TCJA rates in 2026, their combined income puts them in the 28% bracket on the income above approximately $182,000. But they plan to retire at 62, that is 10 years from now. And here is their window. From 62 to 75, that is 13 years, they will have low or moderate income. They have a taxable brokerage account that can generate living expenses. They expect Social Security to be relatively modest since Linda's earnings were inconsistent. In those 13 years, they can engineer their taxable income to sit inside the 25% bracket, which for married filers tops out around $182,000, and convert traditional IRA money into Roth every year in that space. If they convert $65,000 per year starting at 62, over 13 years, that is $845,000 converted. Their $600,000 traditional IRA, growing at 7% from age 52 to 62, will have grown to approximately $1,180,000. They will not zero it out in 13 years at $65,000 per year, but they will reduce its balance significantly, and more importantly, they will have built a substantial Roth balance that compounds tax-free indefinitely. The blended effective tax rate on those conversions, because the first chunk hits the 15% bracket and the rest hits 25%, is probably around 20 to 22% on average. Total taxes paid on conversions over 13 years at that rate, approximately $186,000. The alternative scenario, they convert nothing. The traditional IRA grows at 7% from age 52 to 75, which is 23 years. $600,000 becomes approximately $2.8 million. Their first RMD at 75, using the IRS distribution period of 24.6 years, is approximately $113,000. Their Social Security might be $60,000 combined. That is $173,000 in mandatory taxable income in year one, already in the 28% bracket. By the early 80s, as the RMD factor shrinks while the balance continues growing, those distributions could be well over $200,000 annually. Over 20 years of RMDs, the cumulative tax liability is enormous, easily $400,000 to $500,000 in total taxes paid at marginal rates they cannot control and cannot reduce. $186,000 versus $450,000. Both lead to roughly the same retirement lifestyle. Only one of them required a decision. The clearance rack was right there. There's also a joke I have to make before I keep going, because the tension in this topic needs one release valve. I recently described the Roth conversion strategy to someone who told me his advisor had explained that Roth versus traditional is basically the same if your tax rate stays flat. I said, that's technically true in the same way that driving at 60 miles per hour and parking your car are both technically valid approaches to arriving at a destination. He changed advisors. And the second one, someone asked me if they should do a Roth conversion or put the money in Bitcoin for the same tax-free growth effect. I said, one of those things depends on the US tax code, which has been stable for over 100 years. The other one depends on Elon Musk's mood before 9 a.m. They are not equivalent vehicles. Now let me bring in the piece that connects the strategy to the execution, because a good framework that nobody acts on is just content. There is a specific tool called the Roth conversion ladder, and it is designed for people who want to retire before 59 and a half and need to access converted Roth money without penalty. Here's the mechanism. Roth conversions have a 5-year seasoning rule. Per conversion, the converted principal can be withdrawn penalty-free after 5 years, regardless of your age. So if you convert $50,000 in 2026, that $50,000 in principal is accessible without penalty in 2031. Convert again in 2027. Accessible in 2032. And so on, creating a ladder where a new rung of penalty-free principal becomes available every year. If you want to retire at 55, you need to start the ladder at 50. If you want to retire at 52, you need to start at 47. The 5-year clock does not negotiate. You cannot compress it. Every year you delay starting the ladder is a year of income you cannot access penalty-free in early retirement. And in a world where the TCJA sale just ended and rates just went up, every year you delay is also a year you missed converting at a lower rate. If you are 45 right now, this is not a future problem. This is a current problem. Let me bring Dave back, because Dave is 58 and his situation is actually recoverable. Dave's minimal income, roughly $40,000 per year from a rental property, and some dividends puts him well below the 25% bracket ceiling for married filers in 2026, which is approximately $182,000. Dave has around $142,000 of headroom in that bracket. He does not need to fill all of it every year. Pushing too hard creates state tax complications and potentially triggers higher Social Security taxation. But a disciplined conversion of $60,000 to $80,000 per year every single year for the 15 years between now and his first RMD at 75, we would convert $900,000 to $1.2 million at blended rates of 15 to 25%. His remaining traditional IRA balance is smaller. His RMDs are smaller. His marginal rate in deep retirement stays manageable. And his heirs inherit Roth assets instead of a traditional IRA bomb. Dave's advisor could have run this model in 2023, could have in 2024, could have in 2025. The reason the model was never run is not malice. It is that the existing system assets, under management, annual fee, no particular outcome metric, did not require it. Understanding that is the beginning of actually protecting yourself. There are 3 specific moves that matter right now. Not talk to a financial advisor, that is advice that requires zero intelligence to give and provides zero specificity to receive. 3 moves. The first move, calculate your bracket headroom every single tax year between now and your first required minimum distribution. This is a number you can calculate in 20 minutes. Take the top of your current bracket for married filers in 2026. The 25% bracket ceiling is approximately $182,000. Subtract your projected taxable income for the year, and that difference is your conversion budget. Fill it, not over it. Converting past your bracket ceiling means paying the higher rate on the excess, which defeats the arbitrage. Fill it to the ceiling every low-income year, systematically, without drama. The second move, if your employer offers a Roth 401k option, elect it today, not next quarter. The administrative change takes a pay period. The no RMD rule under Secure 2.0 is permanent law. High earners who are above the Roth IRA income limits have exactly one legal, unlimited, no income cap path to tax-free retirement growth at the source, the Roth 401k. If your plan also allows after-tax contributions with an in-plan Roth conversion, ask your HR department about the mega backdoor Roth. The question will feel awkward. Ask it anyway. The worst that happens is they say no. The third move, if you have children or other heirs and you hold a significant traditional IRA balance, model the inherited IRA scenario explicitly with a tax professional, not hypothetically run actual numbers. The 10-year rule means your heirs will receive forced distributions at potentially their highest earning years, at their marginal rates, with no ability to defer or manage the timing. A Roth IRA inheritance is a gift. A traditional IRA inheritance, in many cases, is a partially unwrapped gift with a significant IRS copay attached. The decision about which one you leave behind is made in the conversion decisions you make right now, while you are alive, in the years when you have a choice. Here is where Dave's story ends, and it is also where this video ends. Dave, in the fictional but entirely plausible world where he actually runs this analysis in early 2026, does 3 things. He calls his CPA, not his asset manager, and gets a projection of his bracket headroom. He sets up an automatic annual Roth conversion for $70,000, which keeps him comfortably inside the 25% bracket while generating some state tax to manage. And he calls his adult children, who are in their mid-30s and earning solidly, and shows them the difference between what they inherit if he does this for 15 years versus what they inherit if he does nothing. His daughter, who is a physician and would be pushed into the 33% bracket by a large traditional IRA inheritance, almost cries, not because of the numbers, but because nobody had ever shown her this before. That reaction, that specific moment of nobody told me this, is the entire reason I make these videos. Not to tell you what to do, to show you the document, to show you the math that somebody already did but never explained. The system is not trying to help you understand it. The system is trying to get you to keep a large traditional IRA balance managed by someone who charges 1% of it. Understanding that is not paranoia. It is just reading the incentive structure. Lazy investing built more fortune than crypto memes. And the laziest, most systematically underused, most thoroughly ignored move in the history of American retirement planning is converting a manageable amount of traditional IRA money to Roth every single quiet year between now and when the government starts forcing your hand. Not exciting, not viral, not a conversation starter at a dinner party, not a ticker symbol, not a meme. The clearance sale closed January 1st. The store is still open. Most people just aren't walking in.